It's incredibly ironic how we usually start our research for these deep
Oh,
dives.
yeah.
I
Totally.
mean, I'm sitting there getting ready to look into this multi-billion-dollar, continent-spanning industrial giant, and the very first thing I'm presented with is a blank white screen.
Right, right.
And right in the middle, there's a little checkbox asking me to, prove I am a human.
Yeah, the classic security gateway. Clicking on those slightly blurry pictures of crosswalks and traffic lights just to get to a financial report.
Exactly. I'm staring at this Cloudflare bot check, squinting at this grainy image of a bicycle, trying to prove I have a human pulse.
Yeah,
And it's funny because it sets this really sterile digital tone. It feels like we're about to dive into a tech startup or like some cloud computing
also
algorithm.
feels very Silicon Valley.
Right. But the source material waiting for us on the other side of that verification, it is the absolute opposite of sterile. Today, we have a massive, really data-heavy Q1 investor presentation for a company called TFI International. And let me tell you, there is no cloud computing here.
No, not at all.
This is about asphalt, diesel, burning rubber, and sweat.
It's the literal physical backbone of the economy. TFI International is a North American transportation and logistics leader. And, I mean, you're right about the documentation. It's dense.
Super dense.
It opens with, pages of those mandatory corporate forward-looking statement disclaimers.
Oh, yeah.
The standard legal armor warning
Oh,
investors that
no.
actual performance could differ from expectations, all that stuff.
Right, which is exactly the kind of corporate boilerplate we are going to skip right over. Because our mission today isn't to get bogged down in the fine print of a legal disclaimer.
Definitely not.
We are here to look under the hood of this massive supply chain machine. We want to figure out exactly how it operates, how it manages to grow so relentlessly, and most importantly, how it prints cash in an industry that is notoriously unforgiving.
And it really is unforgiving.
Okay, let's unpack this. Because to understand how they print so much cash, you first have to, visualize the absolute physical footprint required to move that much product across the United States and Canada.
Yeah, the physical scale is truly their defining characteristic. When we talk about TFI, we're talking about an incredibly extensive network.
Right.
As of this Q1 2026 report, they're operating out of 626 distinct facilities.
Which is just, picturing 626 logistics facilities is wild.
Yeah, it's huge.
Imagine a massive warehouse buzzing with forklifts and shipping bays. Now multiply that by 626.
It's hard to even wrap your head around.
But the facilities are just the stationary part, right? Then you look at the rolling stock, they have 40,831 trailers.
Which is a staggering number.
If you parked 40,000 trailers end to end, you would literally cross a small country.
You would. And the presentation notes they offer a wide range of services to actually utilize all those trailers, specifically focusing on less than truckload, standard truckload, and specialized logistics.
Okay, let's pause right there. Because less than truckload, or, LTL, is one of those industry terms that gets thrown around a lot.
Right.
For anyone out there who isn't running a shipping department, what does that actually look like in practice? And why does it matter?
It's a really great distinction to make. Standard truckload is simple. A company fills an entire trailer with their own goods, and a driver takes it from point A to point B.
Like one truck, one load.
Exactly.
No.
It's straightforward. But the profit margins are generally lower because it's a highly commoditized service. Almost anyone with a truck can do it.
Makes sense.
But less than truckload, or LTL, is entirely different. It's basically the Tetris of the logistics world.
The Tetris of logistics. I like that. So you're combining a bunch of different shipments.
Exactly. You're taking, say, 2 pallets of auto parts from one client, 3 pallets of electronics from another, and a pallet of retail clothing from a third. You consolidate all of them into one trailer at a local hub, drive them across the country to another hub, break the trailer down again, and send the individual pallets out on smaller local delivery trucks.
Wow.
Yeah, it requires massive coordination, complex routing software, and a huge network of physical terminals.
Right, because you have to sort it all out constantly.
Exactly. And because it's so difficult to execute efficiently, the barrier to entry is incredibly high, which means the companies that can actually pull it off command significantly higher profit margins.
So LTL is where the real money is made, provided you have the scale to handle the puzzle.
Exactly.
And TFI definitely has the scale. To pull all those trailers, they have an army of 18,972 trucks.
Right.
And to run all this, they employ 26,354 people. Out of that total, nearly half of them, 12,928 to be exact, are the drivers actually behind the wheel.
Yeah, it's a massive workforce.
But here's the part of the presentation that really made me stop and scratch my head.
Yeah.
They run this entire operation through what they call a decentralized entrepreneurial management approach, operating over 100 different companies. Think about that for a second. Imagine trying to manage just one local business,
Tough enough.
the payroll, the maintenance, the customer complaints. Now imagine running over 100 of them at the same time. It's less like a single monolithic trucking corporation and more like this giant umbrella franchise covering 100 separate mini companies all rolling down the highway together.
It is a fascinating organizational structure.
Yeah.
And, it's very deliberate.
Deliberate or not, I have to push back here.
Sure.
If you have over 100 distinct operating companies, doesn't that create a chaotic nightmare for quality control?
You would think so, yeah.
And what about unified branding? Usually when a corporation gets this massive, headquarters in some skyscraper wants to standardize everything down to the color of the paper clips in the break room. Why fracture your own empire like this?
Well, that assumption gets you halfway there if you're thinking about a consumer brand, right?
Yeah.
Like a fast food chain or a retail store where absolute uniformity is the main goal.
Right. A burger should taste the same in Miami as it does in Seattle.
Exactly. But in logistics, geography and local relationships are everything. What a decentralized approach does brilliantly is keep management entrepreneurial and incredibly close to their specific local markets.
So the idea is that corporate in some ivory tower can't effectively micromanage a warehouse in a completely different climate with totally different customer needs.
Precisely. The manager of a specialized flatbed company moving oil rig equipment in Texas faces entirely different operational challenges, regulatory environments, and weather conditions than, say, the manager of a last-mile courier service navigating the dense urban core of Toronto.
Oh, that's a good point.
By letting these 100-plus companies operate with a high degree of autonomy, they retain the speed and agility of a smaller, hungry business while still having the massive financial backing and purchasing power of a giant.
Okay, that makes sense. You get the local expertise, but when it comes time to buy fuel or negotiate insurance, you're wielding the checkbook of a multi-billion-dollar giant.
Exactly. It's the best of both worlds.
And looking closer at the numbers, I noticed something else that fits this flexible model. They have nearly 19,000 trucks, but they don't own all of them.
Right.
About 12,600 are owned or leased directly by the company, but the remaining 6,300 belong to independent contractors.
Yeah, that split is the secret weapon of their decentralized philosophy. It provides an immense amount of operational flexibility.
How so? I mean, why not just own all the trucks and keep all the profit?
Because a truck is a heavily depreciating asset. If you own a truck, you're paying for it every single day, whether it's moving freight and making money or just sitting empty in a parking lot during a slow season.
Right. It's just burning cash.
Exactly. By maintaining a robust pool of independent contractors who own their own trucks and only get paid when they actually move the load, these individual operating companies have a built-in shock absorber.
A shock absorber. Okay.
Yeah. When demand spikes during the holiday season, they lean on the contractors to scale up capacity instantly. When demand drops, they scale back down without carrying the fixed, crushing cost of thousands of idle trucks on their balance sheet.
So what does this all mean? We have this massive, highly adaptable fleet mapped out, over 100 distinct companies, 40,000 trailers, a brilliant mix of owned assets and independent contractors.
Yep.
The next logical question is, what exact problem are all these trucks actually solving for the people paying them? Because the presentation lays out their customer value proposition, and honestly, it sounds a bit generic at first glance.
Yeah, the corporate phrasing can certainly feel dry. They list their advantages as mitigating risk for customers, improving efficiency, delivery timing, reducing delivery costs, and driving satisfaction for the end consumer.
Right, and I have to play the skeptic here. Isn't improve efficiency and reduce costs just standard corporate filler?
It sounds like it, yeah.
I mean, couldn't literally anyone with a used van and a printed business card claim they are mitigating risk and improving delivery timing? What makes TFI's claim any different from a guy with a pickup truck and a dream?
This raises an important question, and it really gets to the absolute core of modern supply chain dynamics. You have to look past the buzzwords and understand the high-stakes reality of corporate logistics.
Okay.
Let's take that phrase, mitigating risk. In the context of a massive multinational client, a delayed shipment isn't just a box showing up a day late.
So the stakes are a little higher than me waiting an extra day for a pair of shoes I ordered online.
Exponentially higher. A delayed shipment in industrial logistics is a blown global product launch. It's an automotive assembly line grinding to a halt because a single specific component didn't arrive, costing the manufacturer tens of thousands of dollars a minute.
Tens of thousands of dollars a minute.
Yes. Or it's empty shelves at a major retailer during the holiday rush, which translates to millions in lost revenue and a permanently ruined relationship with the end consumer.
Wow. Okay, so when the stakes are millions of dollars a minute, mitigating risk takes on a whole new meaning.
Exactly. And this is where TFI leverages that staggering scale we just talked about. If a massive snowstorm shuts down a major highway corridor, the guy with one van is simply out of business for the week. The cargo just sits.
Right.
But TFI, with its 626 facilities and 100-plus operating companies, can instantly pivot. They can reroute the freight to a different hub, switch it from a truckload operating company to an LTL operating company within their own umbrella, utilize their independent contractors to find a new path, and basically absorb that macro-level risk.
That's incredible.
They aren't just moving boxes. They are selling certainty to massive corporations that literally cannot afford to be uncertain.
They are selling certainty. I love that. It's the invisibility of the process, really. The highest compliment in logistics is not being noticed at all. When things work perfectly, the end consumer never even thinks about the trucks.
Precisely. That invisible certainty is what drives end consumer satisfaction.
Okay, but as I'm looking at this massive map of certainty, something doesn't add up. You don't build a reliable, continent-spanning network of 100 independent companies and 40,000 trailers one truck at a time.
No, you don't.
Organic growth is just too slow. There's no way they built 600 facilities brick by brick. They have to be buying them, right?
You are spot on. And the source material details a mergers and acquisitions, or M&A track record that is, frankly, staggering.
Yeah.
Since 2017, TFI has completed 86 acquisitions.
Wait, 86? Entire companies bought and absorbed.
86.
It's like watching a corporate game of Pac-Man. But the maze is the entirety of North America, and the little dots are smaller independent logistics companies. TFI is just strategically gobbling up these firms at an incredible pace to build out this empire.
What's fascinating here is the sheer velocity of that execution. The presentation notes that out of those 86, 5 of them were categorized as major acquisitions, meaning a purchase price of $200 million or more. So they aren't just buying tiny fleets. They're occasionally eating the power pellets in your Pac-Man analogy. And if we do the math, acquiring 86 companies since 2017 leading up to this Q1 2026 report equates to basically one acquisition a month over a 9-year period.
One a month. Just think about the massive headache of onboarding one single new employee at a normal job.
I know.
The paperwork, the training, the passwords. Now imagine buying an entirely new company, integrating their routing software, taking over their trucks, folding in their HR departments every 30 days for 9 straight years.
It's a lot.
How does a company not just implode from the sheer administrative friction of that?
And that brings us right back to why their decentralized model is the absolute secret to this Pac-Man strategy. Because they operate as 100-plus distinct companies, they don't have to perfectly assimilate every new acquisition into one giant monolithic corporate culture.
Ah, so they aren't trying to force the new company to change the color of their paper clips.
Exactly. When TFI acquires a highly successful, well-run regional player, they don't fire the management and slap a TFI logo on every truck.
Right.
They plug that regional player into the financial backing, the IT infrastructure, and the massive purchasing power of the TFI umbrella. But they let them continue running the local operations that made them an attractive target in the first place.
Yeah.
It's basically plug-and-play logistics.
It's brilliant. The strategic justification they give in the presentation is that the transportation and logistics industry remains fragmented. So the maze is still full of thousands of these smaller mom-and-pop dots, and TFI has built the perfect machine to just keep eating them.
Exactly.
But doing this successfully requires an intense amount of discipline. If you mess up the integration, or if you overpay, the entire umbrella collapses under its own weight. Which brings us to the financial engine.
Right.
Here's where it gets really interesting. Because buying a new company every 30 days requires a constantly replenishing war chest. How does TFI generate the cash to sustain this level of aggressive, endless growth?
The Q1 2026 financial highlights give us a very clear, data-heavy picture of this engine. They report an operating margin of 7.9%.
Hold on, let me look at that number again. 7.9%. So for every $100 they make in revenue, they only keep about $7.90 before taxes and other costs?
Correct.
That sounds Incredibly low. It's like a grocery store model. You only make a few pennies on every apple you sell, so you have to ensure millions of apples move through the checkout line flawlessly every single day just to survive.
That's a great comparison.
But when you are managing over 40,000 trailers, one bad spike in diesel fuel prices or a bad winter that damages a bunch of trucks and that margin just vanishes, how on earth is a 7.9% operating margin listed as a best-in-class financial highlight?
For connect this to the bigger picture, you have to realize the environment they operate in.
Yeah.
Trucking and logistics is traditionally a profoundly low-margin, capital-intensive industry. Trucks are expensive to buy, they break down constantly, they require endless maintenance, and they guzzle fuel. In that brutal context, operating at almost 8% margin at this scale is actually highly efficient.
Interesting.
But you've hit on the exact right instinct, because the operating margin isn't the real star of this presentation. The most important metric in this entire document, the true magic trick of TFI, is their free cash flow conversion rate, which sits at a staggering 86.5%.
Okay, we need to translate that. Free cash flow conversion. What does 86.5% actually mean in plain English, and why is it a magic trick?
Think of it this way. Your operating margin is how much profit your business generates on paper. But paper profit doesn't buy new companies, and it doesn't pay out dividends to your shareholders.
Right, you can't spend paper.
Only actual cash does that. Free cash flow conversion measures how efficiently a company turns that paper profit into real, spendable cash in the bank after paying for all their necessary capital expenditures.
Capital expenditures meaning like the cost of replacing old trucks, fixing warehouse roofs, upgrading routing software, stuff like that.
Exactly. In a heavy industry like trucking, capital expenditures usually eat your profits alive because fleets constantly need replacing. An 86.5% conversion rate means that for every dollar of profit they claim on their income statement, over 86 cents survives the meat grinder of maintenance and ends up as cold, hard cash in their pocket.
Oh, wow. So even though the profit margin itself is only 7.9%, they are incredibly ruthless about capturing almost all of that margin as actual cash.
Yeah.
There's very little leakage.
Exactly.
Their decentralized companies must be insanely disciplined about maintaining their fleets cheaply and efficiently.
Precisely. It is a masterclass in capital discipline. And that massive, efficient cash generation is the fuel for the entire Pac-Man strategy.
Yeah.
Because they capture cash so well, the presentation highlights a 20-year total free cash flow of $7.2 billion US.
$7.2 billion in pure generated cash. That is a serious war chest.
It really is. It allows them to execute on multiple fronts simultaneously. First, they fund those 86 acquisitions without drowning in bad debt. Second, they reward their investors. They explicitly note that $2.6 billion has been returned to shareholders since 2017.
And for anyone tracking the stock, the presentation notes an annual forward dividend yield of 1.7% based on a US 47-cent dividend and a stock price of US $108.63 as of March 31st, 2026.
Exactly. So they are buying companies aggressively and paying out significant dividends to shareholders. But what's truly impressive is how they maintain their dry powder. Because they are so cash-rich, they maintain an incredibly robust balance sheet. The presentation points out they have access to $0.9 billion US in revolving facilities.
Let me clarify that. A revolving facility is essentially a massive corporate credit card, right?
That is the perfect way to look at it. It is a pre-approved line of credit from banks that they can draw from instantly.
So let me get this straight. Even after buying nearly 90 companies and giving $2.6 billion back to their shareholders, they still have a $900 million corporate credit card just sitting there, fully paid off, waiting for the next target to appear in the maze.
Yep.
That is a profoundly well-oiled financial machine.
It truly is. The 8.6% free cash flow yield they report simply underscores this reality. It proves to investors that relative to their overall market value, they are producing a highly attractive, incredibly reliable stream of cash. They aren't just growing for the sake of top-line revenue, they are growing in a deeply disciplined way that generates real, deployable capital.
So bringing all these threads together, what we are looking at behind that generic security box check is a sprawling, decentralized cash-generating machine.
Absolutely.
TFI International isn't just a trucking company, it's an expansive network of over 100 operating companies, heavily utilizing a brilliant mix of owned assets and independent contractors to stay perfectly agile like a shock absorber. They are gobbling up the fragmented North American supply chain piece by piece, turning modest industry margins into a roaring river of free cash flow by being ruthlessly efficient with their fleet maintenance and using that cash to buy even more companies.
And this matters profoundly because this company, and others like it, form the invisible architecture of your daily life.
Yeah.
The next time a package arrives exactly when you expected it, or you walk into a big box store and the shelf is perfectly stocked with the exact item you need for a project, there is a very strong chance that an independent contractor driving under the local banner of one of TFI's 100-plus decentralized companies quietly made that happen.
Wow.
They absorbed the friction and the macro-level risk, so you never had to think about it.
It's the ultimate magic trick of the modern economy. But looking at this presentation and seeing this level of relentless execution, it leaves me with one really big lingering thought.
But
Over the last 9 years, their entire growth engine, this massive Pac-Man strategy, has relied on eating up a heavily fragmented industry. They have proven they are the absolute best at playing the game. But what happens when the maze runs out of dots?
so that's a great question.
When the North American logistics market is finally consolidated and the easy mom-and-pop acquisitions are all gone, how will a massive network of 100 independently minded companies continue to deliver that promised superior record of growth?
It's the ultimate test of their decentralized model. When you can no longer buy your growth, you have to invent it from within.
And that is something the financial disclosures won't tell you. You just have to watch it play out on the highway. Thank you for joining us for this deep dive into the invisible world of North American logistics. Keep asking questions and keep exploring.